Hey guys, what's up? Welcome to another episode with me, Shashank Udupa, and I'm a SEBI registered research analyst. And today we're going to break one more myth in the stock market. Now, last week we made a video of Nifty 50 versus Nifty 100, and obviously a lot of you guys liked it. And we saw how Nifty 100 was actually outperforming Nifty 50. Now, why we did this video was because a lot of people just like to invest in index funds. But even when you invest in index funds, you should first figure out what is a good index fund to actually invest in. A lot of people automatically assume that the default index is Nifty 50. So that was a myth we broke last time. And then one very interesting comment came in that video saying, Shashank, what about Nifty 50 Equivate? Now that actually made me think a lot. Had the team whip up some ideas on this, and we did some study and analysis on this as well, and actually it was quite shocking. Now first let me understand what is Nifty 50 Equivate. Now your traditional Nifty 50 index, right, has a very big dependence on companies like TCS, the companies like Infosys, Reliance, SBI and HDFC Bank, which are all currently not moving at all, and even when they move, the basket is very skewed. Now we say that these are the top 50 companies of India, but they are not equally weighted. They're all differently weighted. So HDFC Bank might have a higher weightage. So that means if HDFC Bank doesn't move, then the Nifty 50 index ETF or mutual fund that whatever you've bought will not actually move. Then we said, okay, what is Nifty 50 Equivate index? Equivate means it takes the top 50 companies of India, which is Nifty 50, but gives all of them 2% share. Everything is at 2%. That means TCS will also be at 2%, HDFC also will be at 2%. Now what happens? The top 50 companies are equiveighted versus custom weighted or market cap weighted. And then what happens? Let's say if a 50th company actually goes up, it gives good alpha to the index. Whereas in the Nifty 50 traditional basket, if the 50th company goes up, it will not impact the basket at all, mainly because that would have a 0.6 or 0.4% stake in the basket. But I hope you understood what is the difference between Nifty 50 and Nifty Equivate 50. Both give the same exposure, just the allocation makes a lot of difference in your returns. Now, again, we all love data, so let's only look at data and make our call. I'm going into screen share mode. Now, this is what I've opened is the Nifty 50 index. This is what I've opened. Now, if you see the Nifty 50 index, this is from NSE itself, right? You can see it here. This is the Nifty 50 index, as you can see. I'm going to show you some interesting things. If you see here, almost 37% of the index is financial services. That means the whole Nifty 50 index depends on financial services. 1/3 of it, literally more than 1/3 of it is financial services. Then we have around 9% in oil gas, which is basically your Reliance major exposure. As you can see here, Reliance itself is 8% and 9% over here is this one itself, right? Then we have HDFC Bank, as you can see in financial services. HDFC and ICICI itself constitute 20% of the basket. That means HDFC doesn't do well, basket doesn't do well. ICICI doesn't do well, basket doesn't do well. Same way, Ulta also. If it does well, it will also do well. And then if you come down, you have the largest public sector bank, then you have Axis Bank, and you have Kotak Mahindra Bank. Now again, Kotak Mahindra is not moving, Axis is not moving, only SBI actually moved a lot, and that is why some exposure was there. But you see how the weightage is so screwed, right? Weightage is 11%, 9%, that means 20, 28, 33, 37, 40. Literally 6 companies, 1, 2, 3, 4, 5, 6 companies have 40% weightage. If you go a little further, you have 3, 4, 5, 6, 7, 8, 9, 10. That's it. 50% is just this. 50% is these 10 stocks in that entire Nifty 50 basket. So what about all the other companies below, your power companies? Nothing gets any impact, right? So this is basically how a Nifty 50 index looks like. Now I'll compare it with the Nifty 50 equiveighted. By the way, this is also on the index. It is not something new. Now why I do these videos is to educate you that there are different types of indexes, there are different types of funds that are actually there in the market, and we will come to which funds are there or what fund you can actually choose on this and all of that, right? We will do some analysis there. Now if you look at this basket, see the difference. Instantly I can see a very big difference coming here. That financial services, which was 37%, is now only 21%, 22%. And what does this do? It gives equal weights, pretty much equal weights to every single person in the basket. So they all start with 2%. Everyone. That means the 50th company in Nifty 50 also starts with the same starting point, same impact to the portfolio compared to all the others. So it is not a skewed basket and it will be a very balanced basket, right? If you see now here, healthcare becomes number 2 instead of oil and gas. If you see here, automobile and auto components become number 3 at 10% instead of the other one. IT is only 10%, whereas in the previous thing, IT was a very high exposure as well. So now you see how beautifully this entire basket is now multi-diversified kind of a basket, right? So that is where the beauty comes into this picture, where it is more diversified than the other, which is again good for us. But again, we need to understand a little bit more about this. We need to understand how the returns have performed, because if the returns have not performed well, obviously you will not like it, and that is what we need to look at. Right now, if you do a simple 10,000 rupee SIP in a simple Nifty 50 fund and you started this 10 years ago, you would have made 21.9 lakh today. And if you had done in Nifty 50 Equal Weight Index, you would have made 26.4 lakhs. The difference between the two, same SIP, same start date 10 years ago, is almost 5 lakh rupees, which is obviously crazy, right? It's a small tweak on portfolio allocation, but you are saying that I want everything to be fair and equivated. And see, these are large cap companies. If India has to grow, they also have to grow, right? Earlier, what used to happen, India has to grow and certain companies have to grow, only then the basket would grow, or only then Nifty would grow. Whereas here, it's a whole different approach that we are actually looking at, right? So this is why the equivate looks very interesting. Now, I'll show you some examples, because I was just looking at some recent mutual funds and NFOs that are coming, because this space was not a very big space in the past, right? Not many mutual funds came out with equivate baskets. So we have to look at very good mutual funds that are coming out. So basically, Axis Bank, they're coming out with an NFO very recently. But before that, let me show you some interesting stats. Okay, we'll only see some stats before we look at what the NFO is. So if you look at the sector, so this is the Nifty 50 Equal Weight. So as you can see here, earlier there were very less schemes in this entire portfolio, right? Earlier there were very less schemes in this entire basket. Now the schemes have gone up, and also the AUM of these schemes have gone up. That means now in the last 5 years, it went from 100 crore AUM, Nifty 50 Equal Index went from 100 crore AUM to almost 9,822 crores. That means smart money has started moving into equivate, because there are a lot of people who are actually doing this analysis. Instead of just Nifty 50, why not do this? Instead of Nifty 50, why not do Nifty 100? So they've started doing analysis of what is the better approach than the same traditional approach that I would go with, right? So this is basically the Nifty 50 equivate. So as I told you, they're coming out with an NFO 3rd July and 17th July it closes. 3rd July is opening, 17th July it closes. Open-ended fund. Let's look at this. Expense ratio to be announced. We can go down. Yeah. So here's what it is. It basically gives an equal basket. Every quarter it is rebalanced. On that, obviously a lot of people would ask this question that Shashank, is it a monthly rebalance or a yearly rebalance? It is a quarterly rebalance. Means every 3 months, everything goes back to 2%, right? It goes, if one company has gone from 2% to let's say 2.5% and the other one has gone from 2% to 1.9% or 1.8%, then what happens is they exit the 2.5, come back to 2, and they put that extra money in the 1.9 and take it back to 2. So it always comes back to 2% every quarter, and it's like a restart. Every quarter it's a restart. Companies that are in momentum will continue going in momentum. Companies that are going to do a reversal, that also you will get a beautiful advantage of it, right? So that is what it is quarterly. Very interesting. Honestly, very, very interesting. And these are some differences, like it's just small differences in how you look at investments and how you change the game. They've actually done a beautiful change here. Look at this. So these are the top 10 constituents. HDFC in Nifty 50, HDFC has 10.9% allocation. In Nifty 50 Equal Weight basket, it gets only 2% allocation. So 10.9 said 2. And if you look at who are the real winners of this basket, we'll go reverse gear, right? If you look at Adani Enterprises, it gets 0.4% in the Nifty 50 basket. Here it gets 2%, so almost a 1.6% increase. Same Wipro 0.5 gets 2, Tata Motors passenger vehicles get 2, HDFC Life, Tata Consumers gets a big boost, Cipla, Max Healthcare, Trent, Geo Financial Services, Apollo Hospitals. So all the healthcare dependent stocks have basically got a good boost, which was not doing a lot over there, right? Coming to diversity of exposure, I told you there you were getting 37% financial services, which is 1/3 of the basket, and then you had another 10% in oil and gas, so almost 47% of the basket was 2 sectors. So if the 2 sectors don't do well, your basket would not do well. Here, it kind of changes the whole allocation into a better kind of a structure, right? So if you look at Nifty 50 as the top 3 sectors of financial services, oil and gas, which I told you, and IT. So this was more than 50% of your basket. Whereas here, the bottom 3 sectors were, this was the bottom 3 sectors, but over here, the top 3 sectors will again be financial services, oil and gas, IT, but the exposure won't be 55% or 60%. Now coming to the returns, again, guys, past performance is not equal to future performance. So please do your own research. My job is to do research and show you data, but this is past data. Okay, so if you look at the past data from 1995, if you look at the rebase, I think it started somewhere in 2003. So from the rebase of 2003 till 2025, you can see the purple line is the equivate basket and the gray line is the Nifty 50 normal index. So if you see it here from a 1 year perspective, 3-year perspective, it has beaten 14%, 5-year perspective beat, 7-year perspective beat, 10-year perspective beat, 15-year perspective beat, 20-year perspective beat, 30-year perspective beat. So overall, it has beaten, and the annualized volatility pretty much the same. So this is how the game actually is structured. Now, as I said, again, this is only an educational video, so I want you guys to do your own research again before investing, right? This is an NFO that is coming out, so you can do your own research about the NFO as well and take your own decision and take your own call. Now, this is mainly for people who are looking at, index funds or looking at investing in simple index funds. They want to understand what is good, what is bad. I'm trying to give them a better approach of investing. Last video also we did 50 versus 100. We saw 100 was better. Now we saw 50 versus equi 50 is better. So if you like such videos, please let me know in the comments, because I have found many more interesting mutual funds that beat your traditional mutual funds, right? So I mean, beat your traditional index funds that you actually talk about. So these are actively managed but will still beat your traditional indexes, right? So if you're interested in such videos, please comment below. And also, I saw that a lot of people who watch this video watch it but don't subscribe to it. So I would request all of you guys, if you could please subscribe to it. It would be great, because we provide a lot of knowledge on this channel, and this will definitely help you grow over a long period of time. So I hope you guys enjoyed this video and like this video. If you have any doubts, any questions, put it in the comment section below and I will respond to that. Thank you guys. Take care. See you. Bye bye.